Thank you. Can you hear me okay? Very good afternoon, and good afternoon to the panelists. Matt, welcome. Thank you, and Vishal, thank you for all the support and for being here. And GV, thanks for coming here all the way from Bangalore. Look forward to a great discussion and interaction. Before we were starting the session, I was asking Matt, what's the more relevant question right now? Is it capital chasing assets, or is it assets chasing capital? And I'm going to pose that to Matt sometime during the session. I'm not going to steal the thunder on what response he gave me, but I would have loved to see more people in the audience. So my hypothesis right now, Matt, is that it's more capital chasing assets. Let's see if the assets come back and chase the capital. I was in a very interesting session a little while ago, and there was a discussion going on, which is a very hot topic for the Indian healthcare. Is what role does private sector need to play vis-a-vis the public sector and along the public sector? And the reason why I'm bringing up this point is because a lot of the stuff which we are going to talk about has more relevance to enterprises, to private capital, and some other things. But there was a state representative that was there in that session. And the statistics which he mentioned were very startling, which justifies why, when we were thinking of having a session like this in this edition of FICCI Heal, it became so relevant and powerful a session for us. He mentioned that in terms of total delivery units of healthcare on which were run by the state, there were 16,000 units. That included 2,088 primary healthcare facilities, 10,000 plus sub-centers, and the remaining between the different types of community health centers and hospitals. And he said of these thousands of units, successful deliveries happen in only 1,800 of them, which is 12%. And out of the 2,088 primary health centers, only about 50% of them are functional at any point of time. And then he said, with all of this, how can we completely dissociate ourselves from having enterprises come and play a role to addressing this large problem that we have? There is no way that we can dissect this sector right in the middle and say, look, we are going to do all of this, because it's not going to happen. And when we do just basic math, and we were trying to just calculate if we were to build the number of beds that are required to build in hospitals, if we have to make sure that there's adequate coverage for basic healthcare, not counting drugs, not taking care of chronic conditions, and the huge burden that NCDs may play on our economy in the next decade or so, and the kind of money that is required at the basic level to get our medical professionals ramped up, we are looking at upwards of $200 billion over the next 3 to 4 years. And I don't think, based on the inventory of capital that we calculated across the various sources, that we have this available. This is why I think this session becomes very important, because if you look at the whole spectrum of what's going on, there are various businesses in healthcare, whether they span from delivery to implants, consumables. There's a lot of new models that are coming out. There are support services, there's education, and requirements of capital, business models, the target markets, and how much is out there does warrant different stakeholders and different avenues. And the paper that was launched in the morning really tried to address the various facets of health that is out there. And if I were to break it up, and that's what defines the configuration of this panel, is all the money that is going after what we are quoting the new economy or the digital healthcare, where we have mHealth, we have consumer portals, we have fitness apps, we have wearables. And at last count, I was reading an article today in the morning where in the last 3 quarters, close to $1 billion have actually been invested just in what we call quote unquote digital health. And if you look around various cities, personally I run a chapter for entrepreneurs in Bombay. And in this year itself, we've enrolled under this whole entrepreneurship community close to 400 startups just focusing on digital health. So that's the kind of activity that's happening from city to city just in this area. Then you have the whole infrastructure, or what we call the hospital space of health, where you need traditional capital, you need to build those hospitals. If you look at the current inventory, and that's where the other challenge lies. And if I were to digress back to the public-private example, the private sector currently runs 60% of outpatient and treats 80% of the inpatient care. And still, there is a huge requirement to build out hospitals in tier 2, tier 3 cities and create models that are economically viable for even cities and towns beyond that. So there's capital required for that, where we've seen both private capital, private equity investors, banks, multilateral organizations, large global financial institutions like the IFC and the World Bank, who've all come in under various models to finance growth of these hospitals. And then you have something that's building out, which we fondly call retail healthcare, which is all the stuff that is walking out of hospitals in various formats, in asset-light models, eye care, birthing, daycare, trying to take advantage of building out better capital-efficient assets. And this has been an interesting place where, again, we've seen a lot of private capital flow in. So what I'm trying to say is all of this, and then we have the donors, and we couldn't have any donor which would have completed this whole panel configuration. And there's donor funding, but unfortunately, and the reality of the situation is, donor funding is reducing in India now. I don't think that the large donors continue to look at India as wanting for the kind of capital that they were wanting. And we are going out calling ourselves now a growing economy, a middle income economy. And a few donors are now being much more selective about the kind of money they're trying to put in on what kind of programs. So we need to look at how we are going to channelize and mobilize the different sources of capital to the right models. Because when we speak to investors, there is continuously confusion on who the right target, what is the right source of capital and finance needs to be, what kind of models. And that was the purpose of this panel, to have a very open, healthy dialogue and debate. And while we have a short session by ourselves, we'd like to open it up to all of you so that we have it more like a discussion. Would encourage whoever are the entrepreneurs, financiers across the room to have a debate and dialogue with the experienced gentlemen that are sitting on this table. And the other thing, if you look at it, which is very interesting, is the role, and it's of immense relevance to venture capital firms across the world, is social media. 72% of online consumers use social media for health information. And there was a Google study that estimated that 77% of patients used Google search before finally booking an appointment. And that number doesn't change much for India. We may think that these are global numbers, but a lot of these, and if you go and trawl through websites, if you see what is being said about hospitals, what is being said about practitioners on social media, it's becoming a more and more relevant channel. And this thus has spawned a lot of businesses around this whole social media space, which was not there a few years ago. Earlier, all we were talking about was hospitals. Then we started talking about clinics, daycare centers. I think a lot we are talking about is about social media. We are talking about technology. We are talking about wellness. We are talking about pain management, palliative care. We are talking about models that are moving out of the hospital setting and into homes. And that's where the requirement for capital, the need for value addition that capital providers need to build, the integration of these models with the more traditional setups become more relevant questions. The last point I wanted to make before I open up the session to the panelists is that even within particular asset classes, there is a dichotomy with respect to returns. And India is not a single market. India is multiple markets rolled into one. And we need to understand that as both entrepreneurs and capital providers. Return profiles change drastically from geography to geography, from town class to town class, because the customer segments are different, the healthcare markets are different. So we can't look at all of the hospitals in the same broad brush or clinics in the same broad brush. And when we look at all the investments, and this is what we thought we'll talk through today, is there's private equity, of course, which has been a great source of growth capital, a huge amount of entrepreneurial support, value addition through management that has come in and has fueled growth of this sector. There are venture capital firms, though the lines get blurred in India when it comes to pure play venture funding vis-a-vis how you see venture funding in the Silicon Valley. Here there is a tip over between venture funding and private equity capital, purely given the ticket size of investments that go in there. Public-private partnerships, and this has been of mixed success by the government. I mean, the government has gone about and put in various models of PPP, whether there are hospitals, there are diagnostic centers, called in private players to do O&Ms of particular clinics and other specialty models, and the jury is still out with respect to what will work and what will not work. There are government investments, and there's a huge opportunity which is coming up, and we see many, many entrepreneurial setups coming up and trying to take advantage or at least build platforms around what is called Digital India. If you see what is happening across the PHCs and CHCs, there is a massive need for automation and technology upgradation. And therein lies a massive opportunity to deploy EMRs, to digitize health records, to connect PHCs, CHCs up through the line. Donor agencies are doing some very interesting work there. So one of the agencies we work with actually has created a platform which automates through an algorithm-based model text messages to expectant mothers. And then they try and track post the 3-month onwards what the risk profile of these expectant mothers would be. And slowly the care pathway, on a very simplistic basis, moves as the delivery period emerges from a normal delivery to a C-section or a CHC requirement. And that's really bringing down the MMR rates in that particular state that donor is involved in. But that's use of technology at the more basic level. I think some of us in the urban areas get exposure to more fancy technology, if I can call it, which is wearables, digital apps, mHealth. But India has a massive opportunity using just simple SMS-based, mobile-based technologies at the basic level at very low costs. And there is a huge market that is opening up out there. So with this, I wanted to stop and open it up to the panel. But really, there were a few questions which I wanted to leave as thought starters for this discussion. Really, who will invest in which part of the healthcare value chain? Because to our minds, each of the components of the value chain have very different economic profiles, different set of entrepreneurs, very different business models, and very different capital requirements. And while all this is happening, what areas can be addressed together? What is the role of social enterprise? And why I bring up this point is that social enterprises in India, in the Indian context, are very, very important. And with respect to social enterprises, what are the new models in health that will attract capital and interest? And as an investor, how do we think entrepreneurs can attract investments as they seek to help to build businesses? So with that, I'd like to welcome the August panel and welcome you all to this session, which is, I think, the last session on raising capital for healthcare, and look forward to a great discussion. Thank you. So Matt, let me pose back the question which I asked you when I started on is it the scenario of capital chasing assets, or is it now assets chasing capital? How has it changed in your experience?
First of all, thank you very much, Amit, and to FICCI for inviting me today. I guess my initial response to your question was, given some of the deals that have passed my desk that I've then seen closed with others, I think either I'm really stupid or really smart, and I'm not sure which the answer is, because they're deals that I wouldn't do, but yet every day you see them getting traction. So, um, I think that might lead you to say, maybe if I'm being overly generous to myself, I'll say that I'm smart and that the assets side is winning, and people are still maybe making poor decisions. But let me take another, maybe less flippant path to answering the underlying premise. And I think one of the things that we've seen as an investor in IFC, we are, for those of you who don't know who we are, we're a part of the World Bank Group. We invest purely in IFC and private sector enterprises. We have a double bottom line, so we need to make a commercial return, but we also need to have development impact. So given that those imperatives, India has been and continues to be probably our most important market in healthcare. We've had up to 1/3 of our investment here, and we're in kind of I think an inflection point in our history in the industry here, that in the past a lot of our investment was in the major metros and the large hospital chains. But now we realize that to continue to meet the developmental imperatives, we have to do more. I think if you have a good solid hospital project in a major metro today, chances are, while I would love to do it, I probably can't, because our board and our partners in the government want us to do something different. So we're starting to take a wider value chain approach, looking at tier 2, tier 3 cities, low-income states, and other underserved markets where we can try to have more development impact and look to address access, quality, and affordability for the poor, but yet to still be able to make the kind of return we need to make for our business model to work. Now, that's been quite difficult, but given that it becomes a chicken and egg question, right? Are those markets underserved? For a reason. So finding those opportunities has been a great challenge, but now more and more we're starting to see, whether you talk about providers trying to build out effective healthcare delivery in chains in those markets, if you're talking about single specialty care, and if you take a wider healthcare value chain approach, we are slowly starting to see opportunities. And then that leads us to a question, whether you're talking about, no matter where in India you're talking about, the question of what's the appropriate way to fund these kind of deals. We were talking amongst ourselves in the panel before we came in here that it's very clear to all of us of the need for patient capital in this industry. And I think that's been one of the stories of the past 5 to 10 years in India, is there's been people taking short-term money because they can get the best valuation that way. So you end up with this kind of alignment of interests between the investor and the promoter, but in the wrong direction, where you have this kind of mutual incentivization to make perhaps short-term decisions in order to justify that valuation, in order to try to get in the next round, to get the exit for the first round money. That maybe in the long run, if you take a long-term vision, isn't in the best interests of that enterprise. So we see, because of people invested 8 to 10 years ago, 7 years ago, 5, with the idea that they would get their exit through an IPO or through an additional fundraising round. And that hasn't always worked out. As we all know, the IPO market just hasn't been there. We're seeing some signs of life now that I think every investor hopes will pay off. But the money is smart enough that people aren't going to overpay now just to reward an investor who made a stupid valuation decision 8 years ago. So these are the kind of dynamics that I think we all face, and we're all both energized and excited about what is still a very big market with room for all of us to be very active, but yet we need to do it the right way, both for ourselves as investors, and I think long-term the promoter needs to shift their thinking in that direction as well.
Thank you, Matt. Vishal, it's over to you. You've had a stint on both sides. And how does the story look for you today vis-a-vis what it was 5 years ago, if you were on the same side?
Yeah, so first of all, Amit, thank you very much. I think this is a fantastic session that we've been able to put together. And it's great for FICCI to actually bring all the stakeholders together on one platform to have this important discussion. So, if you just go back into the history of Indian healthcare and look at right from the first waves of corporatization that hit this country, of corporate healthcare, and just go back into the timelines and you will see that at each level of growth, it's been funded by a second party investment proposition. I don't think that there is any group in this country, any large scale group in this country, which has not been funded by private equity. Right? So first of all, I think let's put this structure together that from a privatization of healthcare in India and for the various models of healthcare in India to evolve, I think private equity has played a massive role in terms of trying to fund entrepreneurs at the right time, trying to fund the right assets at the right time, and eventually create their growth trajectory. What I see when I sit on the other side and having operated assets for a long period of time, I think it is very important for growth to happen right. I think sometime when you're sitting on the other side, and obviously when you're looking at a growth sector which is growing at 15% per annum, and it's probably the fastest growing or amongst the top 2 or 3 fastest growing sector. Healthcare is a long-term business where ROCEs actually kick in at a certain given point in time. And so therefore, to invest right at the right phases, it becomes extremely, extremely critical. So I think one big lesson, and you also know that I'm also an entrepreneur besides an investor, and basically I think that's one big agenda for every entrepreneur. That while there is a lot of capital out there, taking the right capital with the right infrastructure, with the right dynamics, and with the right valuation, and I couldn't agree with Matt more. You make that mistake the first time on by taking a very, very aggressive valuation. You feel great about it, that money is coming at some crazy multiple, but you're never able to live that multiple. And then starts that entire story of dysfunctional capital deployment. So I think from an operating standpoint and from an operating view, great time for Indian healthcare, for investors to come in and take a look at and view the right companies well. And I have no reasons to believe that there are tons of companies out there which will do remarkably well with the capital which is coming in behind them right now.
Thanks, Vishal. And I think you raised a very important point on both the models and the types of groups and teams. And with that, I'd like to ask GV. GV, you've been a very prolific investor, and Sequoia's looked at healthcare both globally and in India. How has the profile of both entrepreneurs and the kinds of businesses that are coming in front of you all changed? And what's the thinking? Is there too much noise? Is there just too much excitement and hype? Or are there really businesses out there for you to fund?
Thanks, Amit, and thanks, Vicky, for having us over. So Sequoia, as Amit mentioned, is a global venture capital firm, and we've been very active in India over the last 9 or 10 years. And about 15% of our investments have been in the healthcare domain. And we invest across 3 broad areas. One is around healthcare in the pharma domain, so branded generics and so on. Second is in healthcare services and delivery. And the third is healthcare technology. And so, in terms of where we started, and that also talks to answers your question, we started with healthcare delivery as kind of the area that we would focus on initially. And when we looked at the entire spectrum, unfortunately, we have this pressure of having to manage funds which are time-bound, unlike Matt, who probably has the luxury of a much longer-term orientation. So we are forced to kind of think about entering companies and exiting companies in a fixed period of time, right? So we have to focus on businesses where, like Vishal mentioned, there's a return on equity needs to be high, and we can't practically afford the long J curves in businesses for them to recover and then deliver the return on equity. So we kind of said, hey, look, can we pick sub-segments within the industry which are capital efficient, relatively speaking? And so we went behind themes which are daycare kind of themes, where you didn't need the very heavy infrastructure to deliver healthcare services. And when we started, most of the entrepreneurs we were seeing were medical in their backgrounds, right? And that's, somewhat natural because you need to know the business before you can start a business. And there were some strong positives of that, and then there were some weaknesses of that. But essentially, what we saw were very highly motivated and highly entrepreneurial doctors who stepped out and started doing stuff, right? And that was the first wave. And in the second wave, we started seeing healthcare being seen as a business much more, right? And what that meant was you could find teams which had a combination of a doctor entrepreneur and investor slash potentially even a businessman who says, hey, here's a great opportunity. I can provide strategic guidance, advice, potentially capital, and I need somebody who understands the business. Let's come together and start something. So that is the second wave of entrepreneurs we saw. And I would say more recently in the last 2 or 3 years, we are starting to see people who have no backgrounds in healthcare, but are saying, hey, here is a large opportunity and it's a big problem which is not being solved in the right fashion, right? What is an outsider's perspective to this industry? And can we start thinking from the basics, right? So what may be a better model of healthcare delivery if I didn't have any of the shackles of having knowledge about how healthcare runs? Can I rethink from basics how healthcare should be delivered, right? And so we're starting these either people that are from backgrounds which are completely outside of healthcare but know healthcare from the sidelines, or people who are technology guys who are saying, hey, can technology be a way by which we can solve the healthcare issue in India, and how do we think about that and create models for that? We are seeing those kinds of entrepreneurs come in. We think these are all very positive signs, because I do think when a fresh perspective is brought to an existing industry, overall industry grows and learns, right? And so they may not know everything about healthcare, but they may ask questions that are fundamental, some of which will be the holy grail you cannot change, but some of which are things that you would say, hey, nobody asked the question, but hey, maybe there's a better way of doing it, and let's look at it again. So that combination is very powerful, and we are very happy that we are starting to see entrepreneurs of that type.
And what would you look at, Matt? What are the 3 things you would look at in an entrepreneur today in India?
Well, I'd look at a few things. One is proof of concept. We're not generally an early stage investor because that puts us to a risk spectrum that we're not entirely comfortable in playing. But there are certainly investors out there who can work in that space. But beyond that, we look for things like a viable expansion plan that passes the initial sniff test. So if someone comes to us and says they've had 2 units that went EBITDA positive within a year, and now within the next 3 years they're going to build 50, that doesn't make a lot of sense. And I think we all see these come across our desk. So a realistic expansion plan that also takes into account one of the things you mentioned in your opening that really resonated with me is that India is not one single homogeneous market. You have all these, there's a reason why so many subsectors and verticals in healthcare are fragmented, because in a way India itself is fragmented. And a lot of people have aspirations for a pan-India strategy, and very few people can successfully pull it off. Because, in its own way, India is really not one country. It's 30 countries under one flag because of the differences in language and culture, in approach to business. And you look in healthcare, the difference between north and south, the difference between the metros and when you move into the tier 2, tier 3 cities. So all these kind of models built around roll-ups and expanding across the country generally have not worked. So we would like to see someone with a vision that makes sense, that is appropriately timed, appropriate to their ability to execute, and that has a plan for how they are going to build up enough management bandwidth to pull this off. And then we can talk about whether the numbers themselves actually make sense.
Do you want to add, Vishal?
No.
So let me put GV then on the spot here, because what's the realistic size, and where would I go as an entrepreneur with a business plan, and what is the number that would excite you?
Yeah, I think it depends.
You as in a venture fund.
Yeah, no, it's a great question. But look, I think this has to be answered within the context of the subsegment you're in. Like to Matt's point, if you had one hospital and he said, hey, here is a proven model and I'm going to now scale it to 50 units, we don't know if it's proven model yet, because you may be operating in one city. Obviously, if you have one center operating in one city, you may be sitting there full time running it, right? So we don't know if you have necessarily demonstrated an ability to take what is a running unit and be able to replicate it and have similar success across. And we all know healthcare services is a retail business, so there are definitely going to be differences in executing in a Delhi versus potentially in a Madurai or a Tanjore or in a Odisha. So in those kinds of models, healthcare delivery models, we do look for beyond one city execution capability to have been somewhat demonstrated before you approach an investor like us, right? But let's take something like pharma, right? And we've had this example where a couple of years ago we seed funded with $5 million a team that came out of a very large pharma company saying, hey, I want to create products in this particular segment of the market, which is a fast-growing segment within pharma. And we have the team to do it. So we met the team. We were really blown away by their capabilities. And they had built a 1,000 crore company before. So it wasn't out of line for us to kind of take a risk with that set of entrepreneurs to replicate what they may have already done, right? Similarly, if you talk about healthcare tech, there is opportunity for non-linearity if you apply technology the right way. So we are happy to go a little bit earlier, but we still need proof of the product or the offering working, right? So we are not really well equipped as generic investors to understand at the deepest level whether a certain technology is the best technology available in the world, right? So we can't kind of say, hey, if somebody came up with a new way of, let's say, figuring out, cancer diagnostics or like figuring out how to treat that using some approach, we are not best positioned to understand that very well. So we look for some source of comfort from other companies using the solution or a bigger company kind of validating it, etc. So it does take us, let's say, 1 or 2 years before we can actually step in and say, yes, now we can do it. So it depends on the subsegment, would be a broad answer, but more non-linearity possible than the earlier we can get into a situation.
Right. And Vishal, do you think a non asset heavy model has very different ways in which it needs to be treated and grown? Because you spend time on a very high asset heavy setup, right? And you scale it up pan India, contrary to many regional models. And now you're on the other side, if I may. What's the big difference?
So Amit, yeah, interesting question. First of all, at the TPG level, so TPG, the fund that I work for, is a $80 billion fund. And out of that, we have $10 billion of invested capital in healthcare. So, and we've been investing in healthcare forever, both on the pharma side, on the delivery side, across the globe. And particularly in Asia, TPG has a phenomenal coverage in terms of healthcare delivery. So I think one of the core areas that we see today, even as a large fund, which is invested behind large build-out assets, is again the ability of a small size, even a single specialty asset, to number one, manage its core right. And even when I look at the smaller single specialty models or the asset light models, I think what is very important is number one, that they're getting the science right. What happens many times is that in this space for growth, we sometimes do not look at the science of things, and you then start just developing infrastructure. But infrastructure does not deliver medicine, right? Infrastructure just gives you the 4 or 5 walls, and that's what it is. But I think what's really important is number one, from a clinical set point, how is the asset catering to that? Again, is the asset, even though it is small in size and even though it may be 50, 60 beds, does it have the required infrastructure for it to complete what it is looking to deliver? Like, for example, I very definitely like the mother and child space because if you take a look at some of them which have sort of taken early bets, these are small size models, but they have been able to deliver, again, in a capital light structure. They've been able to deliver good outcomes. And what's important is that some of them have realized very, very clearly that they can't be all things to everybody. So they have not started to do very complicated, high-end, cesarean work and stuff like that. And they've tried to slot themselves around the areas which they believe they can deliver in the kind of infrastructure that they have. I think on the same side, some of the other, I'm a big proponent for single specialty. I think as we go along and as we begin to see real estate issues in this country. I think gone are the days when we will be building out 400-bedded hospitals. You see how many of them have come up over the last couple of years. And for a country which basically believes that the more beds it puts in, the more will be the consumption, you really see that those kind of hospitals haven't really come up. There are just a handful of them. So with all the real estate challenges that we see around us, we are going to come back into the sweet spot of 150, 200 beds and making healthcare delivery work and making some of the core specialties work within those beds. I think trying to be all things to everybody in the healthcare delivery space is probably the days of that are gone, at least for some time, because we have seen many of them not return adequate value in terms of investor money. And so therefore, I think it's important to sort of begin to look at some of these healthcare delivery models which are very focused, which are capital light, and which are basically, from a metrics perspective, able to deliver on all the metrics of investment.
Right. And Matt, from your standpoint, to the comment GV made, where you do have the flexibility of a longer view of capital, is the way you're looking at your investments in India changing? And if you were to crystal ball this 4-5 years ahead, what's the kind of portfolio you think would be a nice one for you to have?
Yeah, I think, as I mentioned before, our view is shifting both because of the development imperative as well as the way the market has changed. Now you can get, if you've won the genetic lottery, as it were, and were born into a family in a major metro, as opposed to in a very small, poor rural area, you can count on having access to world-class healthcare. So for us as a developmental institution, again, as I mentioned before, we have to find where we can make a play that will support the kind of enterprise that will reach the underserved, but yet still do it in a way that provides quality to the consumer, and can give us a shot at a good investment. I think what will change if you look at our invested portfolio 5 years from now as to where it is today is more diversification, not just in terms of those geographies, but indeed moving more into the single specialty space. We've already started doing that. We've invested in eye care. We've invested in a dialysis firm. We'll look for those opportunities. We are very much looking to find opportunities in the med tech space, both high tech as well as in areas like consumables. And we are more and more really trying to take a wider health value chain approach. What we're also doing is trying to break through the kind of internal silos we had within IFC and the bank group, where we have one group that is very actively structuring PPPs with state governments, so we're trying to leverage that to look for investment opportunities to follow on their engagements. We're also working together with the World Bank on things like quality and the regulatory and enabling environment. We're working on things like direct payment systems, and we're just really very eager to find opportunities that maybe we didn't have 5-10 years ago, and to really help to be a catalyst for the kind of market shifts that we're seeing already. I think one of the most challenging spaces that we see, and it's true on both the public and the private ecosystems, is primary care. We'd love to find an entree into that space, but I think, to be honest, to date, no one has come up with a viable business model yet. And this becomes, we were talking before the session about one of the hardest things in this space is you're really trying to shift consumer behavior. Because right now, if you look, many people in India, when they get sick, they don't enter the system at the appropriate time. When they go in and line up at the OPD at a large corporate hospital, because they figure that's where the good doctors are and they can get the help. So you have this kind of vicious cycle, if you will, where you have an inefficient deployment of hospital infrastructure. You have people who maybe aren't getting the care they need at the appropriate time. But yet, what's going to change? They're still, if you look at it, making a smart choice because they're going to go where they have at least some faith the good doctors will be. So how do you shift people out of that to a more appropriate model where you have standalone primary care, where you have, if you had on the public side PHCs that actually functioned and served their purpose and then could feed into secondary and then tertiary care? So these are the kind of challenges that we're really scratching our heads and trying to find a way to solve, and we hope we can find opportunities to make an impact there.
So Amit, as I was saying, that there are a couple of areas which are still a little untapped. One of the big areas which I see untapped is oncology. India has a huge oncology issue, and in the past, hospital chains have resisted investments in oncology basically because it was capex heavy and all that. But I think with all the changes that have happened on the technology side, on the delivery side, that's definitely an area which needs a lot more focus. I'm seeing some, again, early signs of specialty-oriented, standalone oncology units, which I think is a very positive move. On the diagnostic side, we see the opportunity, again, around the genetics part of things. Dr. Lal is here, and many of the diagnostic chains which have done phenomenally well in the past. I think the time has come to sort of do a value add and move up that value chain, and basically start looking at much more concrete, high revenue base kind of diagnostics. I think the last one, which which GV also touched upon, I think there is this whole space of medtech which is opening up. We at TPG have already invested behind a company which Prabhakar is here, and so I think the question is that we are already seeing early signs of medical technology companies now scaling up and creating a global play for themselves. And these will be basically homegrown Indian companies which will need the capital to grow. And particularly once they've got the US FDA marks and the CE marks and all that, then the play opens up for them. And I think that's the right time for them to get invested capital and really scale it up. So these are some 3 or 4 broad areas, and I'm very, very excited by the medtech opportunity, because I think we've just had a handful of companies over there, and so there's as we started the session, that is it the assets which are looking for the money, or is it the money chasing the assets? I think in that space there has been very little play opportunity, and I'm seeing that happen now. So I think that's again an area that we should really look out for future growth from the Indian perspective.
Right. And on medtech, Vishal, I think you picked up a great point. But my view was that if you look at the whole development ecosystem in medtech, which requires accelerators, incubators, great academia, and entrepreneur linkage, before a Series A happens, I do believe that that's really absent in this country. What's your view and GV's view on that?
So I think you're right. What one is seeing is at least what I'm finding, that there is some good work which is beginning to happen in the IITs. If you see, IIT Mumbai, IIT Chennai, you're seeing these centers come into the IITs in terms of development of new science. I'm seeing a big wave which is happening in this space in the IISc in Bangalore. And you're absolutely right. I think that academia to entrepreneur linkage to sort of grow these assets, and of course, it starts with early stage venture capital to sort of push behind some of these early stage companies. And I think with the wave that we are seeing on the VC side, to sort of back these companies early, because at the end of the day, I think what we have to regret is that we did not really become the Silicon Valley. While we call cities like Bangalore at Silicon Valley, those are just valleys. They have no silicon in it. So, because at the end of the day, there is very little that has really happened, which one can say is innovation driven. Everybody's come and put their house there, but does it really create innovation? Very little, and it's just beginning to happen. So I think what's really important out there is that wherever these early stage connections have built up, this is probably the ecosystem to go and put capital behind. And GV, to you are.
Yeah. My view on this, I think there's two types of innovation or action in the technology side on medical, in the healthcare space, right? One is, when you think about core innovation, which is devising something completely new, I think you're right. In that case, you need much beyond what's available today in terms of cooperation. Not just even think about universities, right? They need to be funded for doing this, and there are like much larger grants in the U.S. to do some of this than some of the Indian educational institutions have. But there is an aspect of technology which doesn't need this ecosystem, and I'll tell you what. The way I think about it, at least, is I think healthcare in the US or UK, when it started and evolved and its peak of when these things developed, their healthcare delivery models were developed in an age where this kind of technology was not available. And in India, we are seeing this completely differently, right? So, we didn't have enough fixed line phones, but we are on the mobile. We are generating this or putting up all this healthcare infrastructure at the same time when technology, particularly connectivity and ability to do video conferencing, etc., is much more available and possible than it was before. So I do think the kind of innovations you will see in India are will be very different from how you see it in the US, and it will uniquely solve the Indian problems, right? So the biggest thing I would see, what we are starting to see happen is the separation of the specialist and the location of where the delivery itself happens, right? So whether it is, we call it telemedicine, but I don't think it's just that. Anything that is based on visual stuff where you need to see something can technically be remotely seen today, thanks to the availability of bandwidth, the ability of devices to stream, etc., etc. So you will start seeing separation of point of healthcare delivery and the person, the specialist itself, right? So we have some investments where people are working on things like telesonology, tele-ultrasound. All of those kinds of technologies, which today is not widely used, but we think at some point will be used. And so it'll be existing technologies being adapted to this healthcare use case, and that stream you will see a lot more innovation. And I don't think that requires much from in terms of universities and so on. I do think people have to just start dreaming a little bit more, and Indian hospitals and healthcare service providers need to be a little more experimentative in saying, hey, if there's a young company coming up with something, I'm going to give it a shot, right? And we find many times they're not willing to take the risk.
Smart, I'll turn to the earlier point you made on primary healthcare and prevention, because while we talked about all of this, I think we've been silent from a private capital attractiveness on that perspective, and it's a very important cog in the wheel, really. Just wanted to get your thoughts. Is it a pure play government-led model that we all as private capital providers look at? B, are there opportunities, and if you see your IFC, if you wear IFC hat on both sides, for social enterprise models to work, at least in semi-urban and rural areas? And if yes, can you share some ideas or thoughts on them?
Yeah. I think the biggest hurdle, as I mentioned before, for us to get active in areas like primary care is that no one's proven that they can build out a viable business model in any kind of scale. So we've met some people who are trying to put up whether the model is something like a family doctor or an urgent care clinic or some kind of a primary model that maybe is built around a holistic approach to providing to having someone to manage the care for the lifetime of the patient. No one yet has really gotten to any kind of scale, any kind of viability. And in fact, I think one of the things that's hurting that space right now is that there have been some obvious cases that have moved in the opposite direction from success. But you also, if you look at the public care system, far and away the weakest part is the primary care as well. So we don't have the answers ourselves. We're hoping someone smarter than us comes up with a model that actually does work. And we do look at other countries and try to see what could be applicable to the Indian context. I think as far as your second question, you touched on one of the current challenges in your opening, Amit, which is that India is in a transition to seeing itself not as a recipient of donor aid anymore. India is seeing itself as a middle income country. So that makes it harder for at least for the international donor community to come in and play as wide a role as it might like to, although there are certainly still those active here. I think also a lot of people in the wake of the last major reform to the Companies Act are looking at the possibility of the CSR requirements as to helping to drive maybe non-commercial models towards addressing some of these issues. I think it's still early days to see if that's really going to work or not. But for us, because we are a developmental institution, we often get people approaching us who are in need of donor funding, of subsidized finance, who are running out of a trust and need appropriate funding for that kind of model. We're not able to touch them ourselves, and I think, unfortunately, the fact that I see so many people in that position really foundering for a way to find appropriate capital, I don't know if it's more a supply question or a demand question, or if simply there's no one out there leading them to the appropriate sources of funding.
So Amit, I think when you say primary care, I think there are two components to primary care. One component of primary care is this whole wellness prevention bit, right? And which is a vertical in itself. And the other one is the one where you necessarily need to consistently go to your general practitioner, to your physician, and because of the shortage of physicians and physicians who are practicing family medicine today or practicing primary medicine today is getting more and more limited. That part of the vertical is beginning to get more and more challenged. I think with the wave that we are seeing around the personal devices, right, and this whole wearable devices phenomena that is beginning to happen, it's literally going down the tab way. Right, when all of us started to buy our iPads, they were like phenomenally expensive, and you see at what value the tabs are getting created today. And I foresee the same kind of situation is going to happen on the wearable side. Right, wearables are probably going to be available for $1 at some given point in time, and with the kind of size and scale that we are seeing over here. So if you start building in the wellness, the diagnostics bit together, and then say that wearables are going to become an important part of it. So there is going to be a lot more personalization around wellness that people are going to go for, and also not just in the urban but in the semi-urban areas. Then that could unlock a business potential in itself, right? Because otherwise this is going to be a difficult game. And as Matt rightly said, that there are tons of companies which have lost millions of dollars of capital in trying to just create models around primary care, and it hasn't worked. So I think we will have to look at a very capital efficient way of using connectivity, which is probably India's biggest boon today, and try and connect that into personal devices, and then see what is coming out of this whole wellness stroke primary care opportunity. And that is, and hopefully there'll be an idea somewhere here which one can take to scale.
Right.
Yeah, I think if I could just add one more point on this topic, this is also an area where the lack of where the problems in terms of insurance coverage make the ecosystem that much weaker, because you have when you look at health insurance here, you have low penetration, and you also have very narrow coverage and very shallow coverage. So because of that, in a lot of markets, you would see the insurance providers pushing people more towards the wellness, the prevention, the primary care, because it's very clear that then helps to cut down on the instances of having to take up the secondary and tertiary care, which gets more expensive. But we don't have in this country an insurance industry that is pushing and motivating consumer behavior and market behavior in that direction, and that makes the challenge that much harder to overcome.
One last hypothetical question from me to the investors. So tomorrow, if we were to have a highly active public health policy, and everything should go the way it goes, there's a lot of investment going in, the public health system is up and running, how would you then look at your investment rationale or thesis?
Let the venture capital start first.
most of our investments are betting against the theme, by the way. Um, Look, I think the beauty about entrepreneurs is they will figure out opportunities given any set of circumstances, right? So, if the public system needs to deliver great quality healthcare, I'm pretty sure there'll be enablers. In the gold rush, you make picks and shovels, and you still make money, right? So, I'm pretty sure there are ways in which entrepreneurs will find company building opportunities within this ecosystem. The way I think about it is, I think the only viable way to make universal healthcare a reality is with technology. I don't see any other way by which you can actually deliver universal healthcare at affordable prices for a country like India, which is so large and diverse, right? And unless we move from this thinking of the specialist being on site near closest to the customer, so the number of inefficiencies that you have in a model like that is just too much. And given today's technology, you can actually pool resources, use. I'll give you an example, right? Like there are people working on machine learning and artificial intelligence algorithms to detect, issues in, let's say, things like ECG or even sonograph or things like that. So people are actually working on things that don't require too much high quality talent on site, right? I think that is a very important trend, and we need to keep investing behind those trends so that you actually have high quality healthcare being delivered at really affordable prices, which is what will drive universal adoption of healthcare. And if that consumer becomes the government, so be it.
So your thesis doesn't change. SICCO stays as is,
Not
right?
change.
So look at it this way, and it's a good question. Look at what's happening to the banking industry. Look at what is happening to the financial sector. Look at what is happening to the banking sector. Highly regulated, deeply penetrated, all kinds of stuff happening in that sector. And then you have these innovative companies like Paytm, which have gone and just disrupted that entire model. And all of a sudden you have this huge adoption of payment banks. Who ever thought a couple of years back that one would even see the reality of payment banks in this country, right? And that was a sector nobody even wanted to touch. So I think what happens with regulation and what happens with industries which get very, very regularized, and first of all, I think it's a great idea if India gets its act right as far as healthcare is concerned. And I do hope that the government finally wakes up to the fact that healthcare is actually a GDP driver, and hopefully we will get there. But I think if it just gets its act right, and if there is that much more that begins to happen in the healthcare landscape, where more investment is going in, more regulatory framework is secondary, but I think just the sheer fact that more capital is going to get deployed, whether public or private, it is just going to give rise to new models. And thank God for the fact that India's innovative index is so high that we will continue to see new disruption. So more the better. And I don't think that our thesis, and particularly from a TPG angle, I don't think our thesis will ever change in terms of investing or not investing behind healthcare in this country.
Yeah, I think I'll first answer your question, then take a broader view. To answer your question, our thesis wouldn't change, because at the end of the day, the things you need to have a quality deal that's bankable isn't going to change. Now, if you look at the idea of we wake up tomorrow and suddenly we have a strong, active, quality-focused and execution-focused public health ecosystem, I think that would actually not crowd out the private sector, but be a boon for the private sector. And this is where, if you look at what's drawn investors into India for a long time, it's because your denominator for everything is 1.2 billion. Okay, so now all of a sudden, if you have an ecosystem where the public half of it works, there's sufficient demand that no one's going to be walking away from the private sector. The opportunities will be there for the promoter who does things the right way, who focuses on quality, who's efficient enough to get the kind of return he and his investors need. I mean, I think of it in this way. I had my global health specialist visiting from Washington, and he's worked in developing countries around the world. I took him out to UP, and we went to a city where, as we drove to the private sector hospital we were looking at, we passed a public sector hospital. And you didn't even have to get out of the car. You looked, and there was no space within the garden outside the public hospital because there were so many people waiting to get in. Then we drove to the private sector hospital and we walked into the OPD waiting room. And my colleague had never seen anything like this anywhere in the world in terms of the number of people there. And the operators told us, well, you know, it's not very crowded today because it's too hot, so people don't want to sit out in the heat. Okay? So if you look at that, you talk to those providers who are already moving into these markets, and you say to them, well, I see the big names, whether it's the Medantas or the Narayanas or whomever. Let's take UP again as an example. Everyone knows they're all starting to break down in luck now. And you ask the local providers, does that make you nervous? And they say, no, there's enough here. We'll all be able to eat at the end of the day. There's enough demand. So having someone else come in doesn't really matter to them. And particularly if that's when you need to start looking at, are you just targeting the wealthiest? Are you targeting the emerging middle class? Are you trying to find a way that you can reach the people who are a little poorer, and you can be efficient enough that some of the government rates can work? And that's where I think the fun really begins.
Well, I can conclude that there's still a lot of capital that's chasing businesses, and I think, Vishal, once I walk out of this, I'm going to turn an entrepreneur. I think that's the best place to be. Well, on this proactive note, House is open to questions. Please just ask questions rather than comments, and do introduce yourselves in a quick line.
So before we start the questions, I have an important announcement to make. Somebody has lost their iPad mini here. It was kept in the inner pocket of the conference bag. So if anybody please finds it, can you please get in touch with Shilpa, who's sitting here from FICCI right in the corner. So sorry about that disturbance, but we didn't want all of you to disappear with the iPad.
Okay, questions? Yeah.
Is your business also in terms of the return fundamentally changing if the environment is changing in terms of the balance?
Yeah, I can go first. Look, for a fund like ours, and I'm pretty sure it's for others here as well, capital is somewhat fungible, right? So we don't have allocated fixed allocation saying we need to invest so much in a sector. So we can't go and make a case, at least to our investment committees, that look, this is a 12% IRR investment, but the country really needs it. I mean, unfortunately, we are not, our investment mandate is not that, right? So to that extent, we need to justify individual investments based on the merit of that investment. In a competitive market, let's say, if we are talking about capital chasing companies in a competitive market, you still need to make sure that if you're paying up because it's overly competitive, you're paying up for the right kind of company, which will give you the necessary returns that you benchmark internally. And we've always found if you find the right market leader in a segment and you back them, even if you paid up a little bit, the chance to positively surprise are high.
I think the way to look at it also is that, one sees many entrepreneurs who first go in for an equity round and then layer it up with tons of debt on it, right? And that's basically because they just need that much more capital, but they want a very high valuation, so they will get very little equity. And then once they've got the equity round in, they just keep on piling debt on it. That's a very dangerous path to go down, because ultimately it comes back to bite in a big way. So I think balancing, number one, between debt and equity is extremely critical. The second one, which is also very important, is that as the interest regimes change, and typically what has India grown on, right? So many of the entrepreneurs who are sitting over here and are out there, many of them have taken bank financing, because their businesses were not probably at that given point in time not ready for any kind of venture capital funding or PE funding, so they went to the bank. I think the question today is, whom should you first go to, right? Once you have a good idea, whom should you first go to? I think the first person you should go to is a venture capital, because ultimately it's not just about the money. It is about also what comes along with the money. And today when I sit on the other side of the fence, when I sit as an investor having operated businesses, I think when you get investor money, what also comes with it is a very different bandwidth, which helps you to execute, which pushes you very hard, And that's the constant conflict which happens between entrepreneurs and with investors, that investors push entrepreneurs very, very hard. But basically, if you see, most of the time, these companies turn around, phenomenally well. That's basically the push that happens behind. The velocity that you give to these assets, to good ideas, is not just capital, but also intelligence. And getting that right is important. So I think as far as, and we are going to see over a period of time, we will see interest rate, changing even here, and then there are long-term interest rate fundings which come out of IFCs, and I'll let Matt speak to it. But that's again a fantastic way to get debt, because it's long-term. It's probably far more like quasi-equity debt, right? So I think those are some of the things that one should be looking for.
One quick point I'd like to make, sort of, and I don't know what's the stage of the funding you're looking at, but in really, really early stages, I think you've got to be much more focused on who you want to go after. Because to GV's point as well, even for venture capitalists in India, they do prefer proven business models with some revenue run rate. I think if it's purely a business plan or a concept, you are much better off seeking friend, family support or angels or HNIs, right? I mean, just in terms of how much time and effort you want to spend and what you really need, do also calculate the amount of funding you need to get to a particular point. I think that's as important as seeking the source of the funding.
Yeah, I think you've gotten great advice, so there really isn't much for me to add. Just, what we look at is, at the end of the day, it's really balancing the risks and versus what kind of return you can get. So I think Amit was absolutely right. You have to get the right type of financing from the right sources at the right point in your growth trajectory. It's and as Vishal said, I think we see many times where people have made the mistake that it's just easier to go down to the local bank where you know the manager and you just you leverage up on the debt, and that puts people, that pressure to service that debt gets people into all kinds of trouble. And the cleaner the balance sheet is at the time when you're ready to move on to the big boys like us to get financing, the better luck you're going to have partnering with the right people. And an element of that as well is you have to have a vision for how you're going to provide an exit to your investors. To just say, well, eventually I'm going to do an IPO isn't necessarily going to work for everybody. And the problem we often get is people tell us up front, well, this is my business, this is my life. I'm never going to let you drag me to sell me to someone else in the industry. And that makes it a little hard for us to find some kind of exit strategy we can have faith in. I mean, we realize that at the end of the day, you can't put two providers together. It's never going to work. It's like putting two cats in a bag and hoping they'll come out unscathed. It's just not going to happen. So, the promoter who comes to me and wants our financing, but is telling me I'll just get you out through an IPO, or says, well, we'll do a buyback, even though they clearly don't have deep enough pockets to pull that off, that then becomes a challenge for me to try to make that investment.
Investors not looking at REITs which have been there for last 2 years and very popular with the West?
The REITs?
Yes.
Matt, you want to go for it? I think REITs have been popular worldwide. REITs have been very popular worldwide, and particularly in Far East Asia. Basically because the return on the REITs and because of the low interest rates. Our interest rates are very, very high, and so therefore the return on REITs over here is just over-optimal. And that's the reason why you're finding that the REITs have not really sort of gained enough and more traction, because our real estate is extremely, extremely expensive, and on top of that, the expectation on the returns on the real estate is also extremely high, which is not so in many other countries around the world. And that is the single reason as to why REITs have not picked up, because ultimately somebody's got to pay the rent. And ultimately it'll go and hit the EBITDA margins. So therefore, I think it's good to sort of say that, there is this big opportunity which is available around REITs, but till the time we don't get our macro finance structure right, I don't think that REITs will be hugely profitable in this market.
Yeah, I have a question. Okay.
So my question is, so like you have been telling that for the primary care setups, the models have not been coming up. If we like to move on with the primary care setups, and we have a models also, but in future, the primary care setups or the primary healthcare setups have to be integrated with the government projects. It has to move on with the PPP projects. So are the investors looking forward that in the future we are going to work with the government? So are the investors ready to inculcate that, okay, the primary healthcare setups is being going to the future being inculcated with the PPP models?
See, I think investors are agnostic to whom you work with, as long as you make money, right? As long as your model is profitable and is sustainable. And I used the wrong word when I said money, but that's the only way to wake everybody up. But you have to create sustainability and profitability out of the model that you create. So even if you're working with the government, and and that model is working well, where it is giving a good return, investors are not going to be worried about that. So investors are not worried about the fact whether you're working in a public-private partnership perspective or you're working in a, under some other different structure, as long as the model that you have created is giving out the margins for that business to become sustainable. And so therefore, sometimes when we talk about public-private partnership in this country, we often find that they are not sustainable products, right? And we have seen many of them roll up, roll back, roll up, roll back. It's happened on the infrastructure side. Highways are a great example. Roads are a great example where there was so much of enthusiasm with which many of them started. Now there are conversations going around airports, and that's not working. So I think there is enough and more that has happened in this country around the PPP structures. But have those structures become sustainable in the long run? That is something that we all have to wait and watch. So if your model continues to create some level of growth based on that structure, not a problem. The investors are going to look at your core business.
Vijay.
Hi, Vijay.
Right. Matt, this is a question to you. I just love the imagery of putting those two cats in a bag. I was just wondering about these two slightly different animals. I don't know how your experience is, but basically the social impact investor and the commercial investor being put in one bag. Any experiences from that?
That is also potentially a recipe for disaster. It doesn't have to be, though. It's at the end of the day, you need alignment in your capital structure. So I don't think it depends so much on where we come from, whether it's an IFC or a Sequoia or a pure impact investor. But if there isn't an alignment between the investors and an alignment and vision shared with the promoter, then it's not going to work. It doesn't matter what kind of cloth we're cut from. So, but the truth is that it's rare to find a really pure impact investor that's going to be in an investment together with a really hardcore, pure commercial investor. But at the end of the day, it's more relevant that you have alignment of interest across the board.
Last question there.
Sorry. From a continuity of funding point of view, is there a bit of a break with respect to the non-pharma, non-tech space? Because from the discussion as well as, the investments that your fund has made, I understand, sorry, Mr. Ravi Shankar, that, there's not too much that's happening or has been happening in that space, while there seems to be a lot of traction at the PE and the debt side. So is there a bit of a dichotomy here in that space?
So are you referring to the pharma space or?
Right. No, the non-pharma and non-tech space, because that's where I've gathered that.
Which is healthcare delivery largely.
Yeah, so basically everything, all the types of different models in healthcare delivery or otherwise.
No, we've actually made quite a few investments in the healthcare delivery space. So, across segments like diagnostics, 2 single specialty chains, that would broadly be the 2 categories that we have operated mostly in. Like I said, I think the timing of when an investor like us enters those segments is different compared to when we can enter a technology-enabled model or even potentially pharma model, because these are real execution, operationally intense businesses, and they scale only at a certain speed. So a fixed time frame fund like ours, where we can hold something for 8 or 9 years, but not for 15 years, need to time accurately so that we can also exit at the right time. So that's why you don't see us kind of going and investing at seed stage in an opportunity like that.
Well, I've been asked by Shilpa to now close this session. Well, thank you so much, audience. You all have been lovely, but at the same time, I think the word of advice for startups and entrepreneurs should be, do describe what you all are doing. You never know, you may find an interesting investor on the table. Thank you very much. Have a good evening.
Thank you so much to all the panelists.